Right. Good morning, everyone, and welcome. We have changed the configuration of this room. It looks like an examination room in the sense of university test room. We're going to cover our results for 2009. Denis and myself will share presentation. In fact, Denis is going to be the one who will speak to you longer. Are seated in the first row François Pierson, Freddy Bouquert, Véronique Veil, and Gérard Darlin, who are there to give you more precise and detailed answers to questions that you may have on any part of our business. We're going to try and be brief because we know that a certain number of you have similar meetings with other institutions of the international markets. So, 2009 results, what can be said? We can say that it was a highly contrasted year for AXA and for the world's economy, which is certainly ending in a better state than it had begun, which shows that AXA is a solid business model with solid results. Our net income has been multiplied by 4 to 3.6 billion. It had dropped very much last year, but it is multiplied by 4 now, which shows the group's capacity for rebound. This is very important when we remember the situation in which the economy and the financial sector as a whole were in last year. And when we look at this now, the operational model that we have now chosen for many, many years, which involves focusing on insurance and asset management, is a model that you can only observe the solidity of throughout this crisis. The sector of insurance in general and AXA in particular have gone through the crisis and shown how solid and resilient they are. This is important because I think that many people last year at the same period were wondering whether this was possible. What allows me to say this? Well, the activity has held up well, although our revenue are slightly down. We see that the P&C revenue continues to grow, although modestly. Life and savings have dropped a little bit because during the first half of the year, most of our clients were adverse to risk, and they have returned slowly. The inflow in life insurance was 8.6 billion euros, and new business value margins have remained high and have even slightly increased. Now, our underlying earning, 3.9 billion euros, slightly down versus 2008. In fact, this is something which, as Dennis will explain, hides very strong increase in the life insurance revenue and a strong deterioration in P&C due to climate events and recession. But the result is therefore high, and you can see that the group's capacity to generate recurrent profits is very strong. The following and third element, which is important to us, of course, is the fact that we have been able to increase the strength of our balance sheet. Our solvency ratio is up 44 points, so we have restored our position to the pre-crisis situation. And our debt gearing has gone down by 8 points to 26%. Now, of course, this was assisted by our increase in capital, but at the same time, this debt gearing has dropped. So the group's balance sheet is strong, activity and business are strong, which allows us to offer significantly higher dividends. Out of caution, we had dropped it very much last year. We are now proposing and intend to propose to the shareholders meeting a payout of 0.55 euros per share, 55 euro cents, for example. representing adjusted earnings and excluding exceptional items. Now, last point here is the embedded value, which is a technical aspect, but which shows the value of the company per se. This embedded value is up nearly 50% to 13.4 euros per share, which demonstrates that as soon as there is a rebound on the financial markets and a return to normalcy, then we can see that the group's solidity is once again demonstrated. This is our landscape. The landscape is one of gradual exit of the crisis of the economy and financial markets, solidity for our business with very strong rebound in life insurance, erosion in our P&C revenue, and therefore a certain number of measures that we are currently implementing to redress that business area. But in all, a landscape which points to our capacity for recurrent results in our basic activities that Dennis will now go into the details of. Thank you, Henry. Good morning. I will cover the different pages of the presentation with you, and we will begin with our revenue. As Henri de Castries said, our revenue was slightly down throughout the year, 1% in adjusted and 3% in comparable basis at constant scope and exchange rate. The drop in the revenue, essentially in life insurance, although we have seen a clear improvement because this was down 6% over the 9 first months of the year, and it is now only down by 4% over the year. The revenue has also dropped as regards asset management. This is mechanical because average assets under management dropped in 2009 versus 2008. We are after the crisis, not before the crisis. Small hike in P&C, which is relatively satisfactory in a world recession context. Now, if we look at the evolution here in our revenue on the right-hand side of the presentation, you can see that the highest growth is in the Mediterranean and Latin America, 13%, pulled forward by the very positive results in life insurance in Italy in our JV with the Montepaschi Bank. Second level of growth reached by France, better than the market in life and P&C alike. And this will continue in 2010, where recruitment will be maintained to bring in 2,000 people. Adversely, we can see a fairly strong drop in North America, in the US in particular, because we here focused on the profitability of products versus market share. And we accepted to lose market share, but we were in fact the first to reprice our products, and we hope that this is a temporary drop. Now, if we look at net inflow, we can see that this inflow has progressed in 2009 versus 2008 in life insurance, which is interesting to observe because when your revenues drop, you could expect, and rightly so, to have lower inflow. But in fact, this means that our clients have also remained more faithful, and we've had less buyback to undertake with our clients, which has helped our revenue to progress. In P&C for personal policies, we have had more clients coming in. On the other hand, as regards asset management, we had negative inflow, minus 71 million euros, particularly in the US at AllianceBernstein, where the customer base is institutional. And this, of course, is the delay in the performance of management in 2008. It has turned around in 2009, but it takes time for clients to return and come back from the selling to the buying approach. Now, new business value in life and savings, this has gone down, and this number, of course, here demonstrates here the lack of serenity of the market at the beginning of the year. We have now progressed 14%, and the value in all has increased by 5%. The evolution in the margin is due to a more favorable business mix, due to the repricing of our variable annuities products in the U.S., and also due to more favorable financial markets. It is partially offset by the fact that with the drop in volumes, we have an increase at unit prices, slight increase in unit prices, because we have not reduced our sales forces as our business went down. Now, let us look here at life and savings underlying earnings. This result has grown by 51%, which results essentially from a positive turnaround in the U.S. I'll come back to this in a few minutes. Remember that in the U.S. in 2008, we had a loss on variable annuities coverage, which appears in our technical margin. So the technical margin was negative last year, but it has made progress by 1.9 billion. Other items such as margin on assets and expenses, for example, have deteriorated. Margin on assets because we've continued to serve our policyholders fairly high level rates, whereas we were initially investing at lower rates, and we lost approximately 40 basis points on our margin on assets. Expenses, the impact here of these expenses, essentially overheads, is negative because we have amortized more acquisition costs in the U.S., and in a general manner, our administrative expenses have increased by 2%, whereas our sales were dropping. So we have a slightly negative scissor effect on expenses. We were fairly rigorous in their management, but we could not prevent slight deterioration of the situation. If we now focus on the American situation, you can see upper left-hand side that we had a drop of 225 million euros in 2008 to a profit of 545 million in 2009. So we have seen here a slightly higher assets under management level, up 9 billion euros, which is fairly favorable for 2010. We were also fairly rigorous in the way in which we repriced our products in variable annuities and in traditional life insurance products. This was translated by a drop in our sales because all of our competitors were not as reactive as we were to the change in market conditions, and particularly to the drop in interest rates. So we have an improvement on new business margin, but we are penalized by our unit costs. So Henry indicated earlier on that we'd launch a new product called Retirement Cornerstone that we are expecting a lot of, and a lot from, rather. The risk for the insurer is strongly reduced versus the past, but there are also innovations in this product which we believe should allow us to hike up our performance in 2010, and therefore we are relatively optimistic as regards our situation in the U.S. If we now go in to property and casualty underlying earnings, this, I must say, is the negative point of 2009. It dropped by 30%, 3.0, versus financial year 2008. Our combined ratio remains good at 99%. We continue here to bring in profits for underwriting, which is important, but it is nonetheless degraded, this combined ratio, by 3.6 points. For several reasons. First of all, this is due to natural events, storms, the Klaus that impacted France and the north of Spain, also hail in Switzerland, floods and storms in the UK. And I think that we have had a year which is way above normal in the natural events category, representing 1.7 points of a loss ratio. We also see degradation, and this is due to the recession, degradation in our adjusted loss ratio of 2 points. and expense ratio, and also this has an impact. Other movements are relatively limited, so I think I have underscored here the main points. François Pierson, with his new responsibilities in the P&C area, will, in 2010 and following years, work on improving the technical margins of our activities throughout the group, and particularly in Europe. We have also reacted to this deterioration, and we have begun to increase prices in P&C. We have to do this to avoid further deterioration. We've increased them a little bit as regards personal insurance and commercial insurance. And you can see at the bottom of this chart that the increases have varied in rates according to countries. Ireland and UK, where deterioration of market conditions had been extremely strong in 2008 and 2009, are showing the highest increases, while the other European countries are more moderate. If we now go on to asset management, we can see the underlying earnings drop by 40%. Here, no one is surprised. The assets had dropped. The markets had dropped continuously throughout 2008 and until March 2009. It is therefore logical that asset management results have also dropped, since we withdraw commissions on these assets, which of course have dropped. We have reduced our expenses throughout 2009 in asset management, but this drop did not suffice to offset the drop in revenue, which is 25%, drop in expenses 14%, so you can see that there is a negative differential. But over 2009, they should lead to a positive effect in 2010, because when we look on the following slide, the assets under management end of 2009 versus average assets, you see that those of end 2009 are up versus average over the same period. So we start the year with a higher level of assets where we continue to work down throughout 2008. So there's a very favorable effect that we can expect throughout 2010. If we see a progression of 5% in these assets, the result should be impacted and reach a 10% growth. Just to give you an idea of the sensitivity here of this particular item. Here as well, we have a division of results per asset manager, and you can see that at AllianceBernstein there was a 53 billion euros drop in net inflows, which was much, much higher than that of 19 billion at AXA IM. So we have work to do to turn things around, but once again, a very positive management performance at AllianceBernstein will certainly help us to redress the situation further. In all, the underlying earnings, all business areas combined, has dropped by 6% to 3.854 billion euros, which is a fairly good result in a highly deteriorated environment. We here have seen a turnaround of the markets in March. The first quarter was extremely difficult, and you can see it in this underlying earning level, which is slightly down. And the amount was 3.8 million euros. Now, here, the adjusted earnings and net income, you can see a drop of 8% in adjusted earnings, as is the case for underlying. But what is important here is that capital gains are stable, and there is a strong drop for specific depreciation that have gone from 2.8 billion to 1 billion in 2009, and 2/3 of this billion had been recorded during Q1. You have the first half here. You see that this is done definitively, and when markets indeed are restored, we do not recover this provision. So you will see this in the increase of unrealized capital gain numbers. The third element here as regards adjusted earnings is that in 2008, we had benefited from profit on the coverage of our equity portfolio at 1.6 billion euros, and this profit was not repeated in 2009 because we, in fact, reworked these coverages when the market was very low in 2009. If we had left them as they were before, we would have lost the profits that we'd made in 2008. We did not leave them as they were, and we benefited from the turnaround on the markets, but we're not going to renew the level of coverage we had in 2008. Now, as regards sustainable services, here we have the most rigorous approach. We depreciate if shares drop by 20% or over a 6-month period, whatever the percentage. And therefore, we have had less depreciation in 2009 because we had much less delay effect than some of our competitors. On the right-hand side here, net income has been multiplied by 4. As Henry told you, it was multiplied because we were not impacted by the mark-to-market of most of our bonds portfolio. So we here saw a tightening of credit spreads, whereas we had been submitted to a loss of 1.5 million euros in 2008. And we this year have seen a profit of 1.1 billion simply because of this tightening of credit spreads. We told you last year that part of our results are not economic, but we can say the same thing this year. In other words, the enlargement of the credit spread in 2008 had penalized us and has been offset this year by the tightening of the same credit spread just to reposition things on an equal ground. This because in our activity we keep securities for long term, and the mark-to-market doesn't have much interest for us in this case. In the result as well, we see a drop of 400 million euros, which corresponds to the strategy that we had selected, which was to protect our statutory shareholder equity in the U.S. So as to avoid having to re-inject capital if the market continued its deterioration in 2009. And this is the price that we accepted to pay to not have to further reinforce American private equity in the U.S. And we already had to do this in 2008, as you remember. And this is a very cautious strategy that we chose. Now, the turnaround of this net result also here further strengthens our financial situation that you can see here through shareholders' equity, which go up to 46.2 billion euros from 37.4. So we are now with shareholders' equity that are above those of past year, and we also have a cushion of net unrealized capital gains of 4.7 billion plus 2.6 here, which involve expectations on property, which are perhaps not as high as they were end of 2008, but you can see that the deterioration here as regards property was certainly moderate. Here we see also variation of unrealized capital gain 4.7, and for the Australian operation as well, minus the dividend paid out in 2008. And here pension deficits due to the situation of the interest rates. The interest rates, including credit spreads, lead us to increase our retirement engagements, particularly in the UK. Solvency 1, very high up from 127% end of 08 to reach 171% in 09. You can see that we have returned to our solvency levels of pre-crisis periods, which allow us, of course, to propose a dividend payout up 40% as indicated by Henri de Castries, but quite significantly under the dividend of 2007, which was 1.20 euros per share. Solvency 2 measured by the impact study number 4 undertaken 2 years ago shows here progress of 50%, approximately 185% end of 2009 versus 150% in 2008, therefore. At least as regards the latest impact study, our position is quite comfortable. If we now look at the balance sheet of the group as a whole, the main information to 0809 is a drop in cash from 8 to 5% of assets, and investments here in different bonds. We have govies and related corporate bonds because our positions were strong, and we reinvested in bonds throughout 2009 by taking advantage of the fact that these corporate bonds gave a fairly high credit spread. End of 2008, i.e. a year ago, everyone was wondering about the quality of the assets in our balance sheet. And we can give you here fairly reassuring news. First of all, the asset-based, asset-backed securities were at 69% of nominal end of 2008, 66% at the end of H109, and are now at 70% end of FY09. So we are at slightly higher valuation levels than those that we showed end of 2008. Real estate or property has dropped in value after the first half year, but this became stable over the end of the year. Same is true on alternative investments or private equity, because here we have seen a slight drop in value of 13% first half 2009, and for the entire year it is 15%. So once again, stabilization of the values of these assets. Now on hedge funds, which for the first time had shown negative performance in 2008, we were able to return to positive levels in 2009. And finally, Henry mentioned this, as regards Greece, we have a fairly quiet situation as regards the PIGS, i.e. Southern European countries, with net exposures that remain quite limited when we compare this to the total numbers of our balance sheet. So we have no specific worries about the Southern European countries that have been in the news over the past few weeks. Now, the group's embedded value has improved sharply from 9 euros to 13.40 per share. Embedded value is, in fact, the portfolio value of the group if it was put in runoff immediately. So our immediate value is 13.4%. If we believe that we have more potential than that, our value is higher. A dividend, of course, goes from dividend per share, goes from 0.40 to 0.55. And we have maintained our cautious approach, but we believe that our shareholders have remained loyal and deserve to be rewarded for that loyalty. Thank you very much. And I will now return the floor to Henry for his conclusion. Thank you. The context in 2010. I would say that the macroeconomic landscape and context are uncertain, although we do seem to be approaching a form of exit of crisis. What is important in this context is to know whether equity markets are going to become more stable, which is the impression we have. Also, what will be the slope and levels of interest rates, and will profitability remain high? So it's a relatively uncertain economic context, which is significantly better nonetheless than that of last year's. Our regulatory frameworks are also changing quickly, perhaps less so than in the banking sector, but because the insurance sector was not submitted to the same difficulties. However, all the discussions around Solvency II are very important for us. We remain on our positions. That has been our position for a long time, which is that the principle and architecture of Solvency II seem very positive. It is an economic risk metrics system, but of course the fine-tuning and the honing of Solvency II will be important. And this is where I think that there are real vectors for improvement, and our hope is high in that the European Commission will ensure that this directive is implemented within the spirit and according to the rules voted by the European Parliament, i.e., without over-conservative positions which would serve no purpose. As far as insurance is in itself is concerned as a business area, it seems once again that the sector has suffered in its asset base. But when we look forward, it seems to us that the context is more favorable because savings rates are either remaining at high levels, particularly in Western European countries, or are being hiked up, as is the case in the US. This savings correspond to the fact that people need savings to prepare their retirement and to face issues that may arise during these last years of their life. So they're going to be seeking protection and guarantees, and this is what we are good at. So life insurance in the long term, after having gone and had to weather a storm in 0809, similar to what we'd sometimes experience in P&C, open perspectives, which in my opinion are positive. And P&C insurance, which has suffered deterioration this year because of recession and climate events, have real improvement possibilities for the future, both because the recession will not be eternal, and also because as regards our technical measures and the way in which we manage our group, we do everything to ensure an improvement of our position in these areas in the future. Things have already been done, particularly in terms of pricing. Now, a brief concluding word on the insurance sector in general. It seems to me that we are too easily limiting the financial sector to banks today. If we want a stable financial market contributing to the economy over the long term, insurers can contribute, and insurers do not work with the same business model as banks. The crisis demonstrated that insurers did not require additional capital. Look at the major European insurers, those who remain focused on their core business did not lose out. And it seems also that their balance sheets are solid, although as opposed to an idea that circulates, they're highly transparent. The balance sheet of insurers is very transparent. As I said, there's no opacity at all. 98% for AXA, for example, and mark to market. So this is important for asset valuation. I also think that this is something that the market is gradually beginning to understand, and that we can, in fact, here reassure those who were worried last year. We are certainly not in a prosperous period of our economy, but I think that in view of the gradual exit from the crisis, I can say that insurance in general and AXA in particular should be able to come out strong. And we need to remember that for the future, AXA in terms of insurance has become brand number one. Whatever survey you look, Interbrand or others, we are the first globally, which illustrates client confidence, confirmed by positive cash flows. And in both developed and emerging countries, we really have the feeling that this will allow us to grow, to continue to grow on the basis of our business models as applied now for a very long time. These were my concluding words, and now we are here with Freddie, François, Denis, and the rest of the team to answer any question you may have. Ladies and gentlemen, who would like to ask the first one? You will be given a mic. Hello, Anderschander Platt, Germany. 2 questions. The first on asset management. Could we have an explanation as to how you will here turn around the situation? You have stabilized your average assets under management, and you communicate in underperformance at AllianceBernstein and also AXA IM. So what are the measures that you've implemented? And as regards P&C, we are low in the cycle. Should we expect an arbitration here in P&C into 2010? And will you react by increasing your prices? And second question, as regards AXA APH, the operation underway, where do you stand in your negotiations with Anabi to take over all of this activity? Right, so we're going to answer the three questions. As regards asset management, this was explained by Denis. The drops in inflows are the result of unsatisfactory management performance in 2008 at AllianceBernstein in particular. I'm sure it did not escape your attention that we have changed the CEO of AllianceBernstein at the end of 2008. It is our feeling that as regards this company today, the poor performance accident was not the result of severe weaknesses in the model, but rather due to the fact that when we were investors in their specialty in 2008, we were financially overexposed, which has had a negative impact. Peter Krause has worked in detail with the entire team of AllianceBernstein, and the management performances throughout 2009 have returned to between good and very good. Of course, it will take some time for clients to realize this and come back, but this is definitely something that gives us trust in the future. As a matter of fact, if we look at private equity and mutual fund clients, these are two sectors where inflow has returned to balance. It's still negative on institutionals, but on mutual funds and private equity, it has almost reached its prior levels. Now, I need to add something, which is what I was saying earlier on. In 2009, we have lost assets because many clients exited those risk investment categories to turn to monetary instruments. And we do not have, because these are very, very low margin activities, we do not have any monetary products to offer. With a return of appetite for risk, we believe that people will come back to this. I think for AXA IM, it's the same thing. Disappointment followed assets under management by Rosenberg. After years of excellent performance, Dominique Carabier's teams and Rosenberg's teams have worked together on implementing corrective measures. And we hope that this will be visible in terms of performance levels. And I think here again that gradually we will return to positive. On P&C, Francois, would you like to say something about the measures that were implemented and what are the perspectives to return our combined ratio to a normal level? Under one reservation here, don't forget that we were between 95 and 100, the interval of P&C. We are not out of this interval. We're at 99, and we believe this situation will turn around. I think that we must not be overstressed here, particularly if we compare this year to the preceding year, which was an exceptional year. P&C, AXA, and particularly in France, our technical results were unprecedented. So we are comparing ourselves to an excellent year. Also, the loss ratio in 2009 is not a structural loss ratio, it is conjectural, which stems from exceptional climate events, but particularly as regards an exceptional breakdown of all of these claims. And we have, in fact, here, during the storms and so on, remained under our retention. Now, when we compare that to storms of the same nature in the past, we had also needed to call upon reinsurers. So when we look at 2009, we realize that, in fact, we have kept everything. And if we look at France, since France was most impacted here, we have approximately 2 million euros in our technical charges due to climate events. The rest of the downward slope is, of course, linked to our adjusted loss ratio, and particularly in automobile insurance. This is true in France, but it's also true in the rest of Europe. There was a crude circulation in 2009, a product mix which changed. In other words, we have sold insurance policies for cars that had less horsepower. Obviously, the policies were not as high. This has to be taken into account. So it's not a structural imbalance in the portfolio that demonstrated weaknesses in 08, and which of course is responsible for the deterioration of result. It is the crisis. So more vehicle to be insured that are not as powerful in terms of horsepower, as well as climate events. So how can we fight against this? Well, we can cross our fingers that we will not have storms as severe as Klaus every year, because they say that this occurs every 30 years or every 10 years. The acts of God, I'm sure that God will be nicer to us and insurers in general in 2010. That's the first part. Second part is, as we are on the personal risk, now you've seen the diminution in number of average premiums, and we will necessarily increase in all of our countries our average premiums, but will remain extremely attentive to client retention. So it will be through segmenting our portfolio that we will reach these goals. In other words, this means that we will increase a little more the clients who deserve to be increased, and increase a little less the clients who really deserve that we keep them. So this involves the way in which we control personal risks. This is a result which is aligned with what we have programmed. Now, as regards the rest, if we look at corporate risks, here again, we will increase high prices on highly vulnerable risks, and we will be a little more selective than in the past as to how we control our operations. So, in summary, low growth in P&C in 2010. This is our forecast. This being said, I think that we will have a very positive impact on technical turnarounds. So low growth and growth, because in some countries there's no reason not to foresee that there will be growth, and very rigorous technical performance all over the board. Dennis? APH, remember that we had set up an alliance with AMP, who is the first life insurance company in Australia, that we had made an offer, that we had made a better offer toward mid-December, and that we were exceeded by NAP just before Christmas. Now, this National Australian Bank offer was based on the fact that they thought that AXA would buy back the Asian assets of our Australian company at the same conditions as the ones we had negotiated with AMP. We did not open the discussions with NAB until end of February, which was the end of our exclusive period. Then we started negotiating with NAB. You may also have seen that about a week ago, the competition monitoring authority came out with a first opinion on the operation that had been put forward by AMP, and instead of refusing it or approving it, the authority asked for complementary information involving all players, AMP, NAB, and all the others. And the authority will give us its opinion on March 17th and let us then know if it in fact authorizes the acquisition by AMP or by NAB both or none. And so there is still a certain level of uncertainty as regards the possibility of a merger between both of these Australian companies. If this merger is possible, then we are still in a good position to acquire the Asian assets at the price that we had initially agreed upon with AMP. But I think that this operation will leave us with a suspense around us for a few more weeks yet. So nothing is certain on the topic. You need to closely monitor news from Australia to know precisely what's going on. But we remain confident as regards our capacity to purchase the Asian assets at the price we'd indicated in December. Next questions, ladies and gentlemen. Good morning, Attilio Geroni, Italy. Are you 100% satisfied with the level of cooperation that you have with Montepaschi Bank? And second question, are there possibilities for external growth for you on the Italian market, and particularly for Fondresa? Well, we are extremely satisfied with our cooperation with our friends from the Montepaschi Bank. When you look at the results and the detail of these results, you will see that the growth of business in Italy has neared 65% last year in life and savings. Also strong in P&C with Montepaschi. I also believe that our Montepaschi friends are happy. This is an excellent illustration of what a bank and an insurance company can intelligently do together. In other words, the bank contributed its knowledge of the local market and its networks, and the insurance company brought with it the sophistication of its products. I think this is a really win-win situation because the Montepaschi Bank clients are satisfied. Both operators, in my opinion, also are. Everybody is very happy with this cooperation. And we have a high-quality relationship with our friends from Montepaschi. Please remember that Mr. Musari is a member of the board at AXA, and the head of our common subsidiary is a member of the board of Montepaschi. So we are really delighted with this because it is the perfect illustration of what can be done with intelligence on the Italian market. Now, are we interested in external growth opportunities in Italy? You know that the French have been turning to Italy for centuries with love, and that the quality of the adventures they find there may sometimes be uneven, but for the moment, for us, things are working out very well with Montepaschi. We, of course, are looking into other possibilities, but we never make any comments on specific topics. Marie-Noël Blessic from AFP. Two small questions. How much did the Klaus storm cost you? And secondly, could you tell us a little more on the situation of life and savings in France, where you said that you wanted to recruit 2,000 people? François? Klaus, both France and Spain, perhaps? And then life and savings in France. Spain, well, France is 125 million. That the cost, of course, net of reinsurance. In space, we can add another 50 million with a rounded figure of 170. So it's fairly significant, to be honest. Since in the past, when we looked at this type of claim after the storm, there was a percentage that was different. This is the impact on the figures that we put in our results, exceptional distribution of money to settle claims because of a storm on life and savings in France and recruitment. Life and savings in France in 2009, well, our growth is way above that of the market. If we differentiate between personal life insurance and group life insurance, we are within market costs in individual life, and we overperform the markets in group insurance. Of course, in group we have retirement, but we also have the progress of protection contracts, healthcare, where our development has been strong, and at the same time, developments are supported by very satisfactory technical margins. And this is what was done in 2009 for life insurance. And recruitment in 2009, what we can say, when we look at the landscape, there are more people in 2009 who have a contract with AXA, salaried employees who have a contract with AXA in France. Because if I add the sales force, that is salary, the administrative functions, all those that we recruited, particularly as regards our salaried sales forces, if I remove those two items, well, the results of the staff in France, salaried employees in France, gives us an increase in the number of people who work with us in France, and therefore a higher number of people in 2009 than in 2008. Other than in France, we've increased the number of salaried employees. We've also increased the number of distributors, general agents, and so on. Branch employees are striking arms, so to speak, but they have no contract with AXA. But on both ends, the staff has certainly increased. We've created additional jobs. Of course, this has not been done in hordes of hundreds of people, but I think the number is approximately 100 people more versus last year. But this is the commitment we've taken vis-a-vis the unions, for example. And we complied with this in 2009, and we will keep to it in 2010. Yeah, but you need, of course, here to differentiate between the growths and the net. We are a net job creator, and we create more salespeople than we hire administrative people. Yeah, so in fact, I was answering the question saying you're recruiting a lot, but there's a lot of people who leave. So finally, there are less people in AXA than there was before. That is not true. Which is not an impediment as regards our progress on productivity. I would like to return to storms for a second, just to make a general comment. It is our business to compensate clients when they have a claim to settle. In 2009, the storms were not only financial. We had different storms, different climatic events. And I think that it is important for us to show that we can be sustainable in our approach to our client. In 99, 10 years ago, I think that the quality of insurance services was better perceived because people had a concrete opportunity to see it at work. So even though these events are not very pleasant for our operating results, they do constitute an opportunity to show that what we do is useful. We're not embarrassed. On the contrary, we did everything we could to quickly and at a high level compensate those who suffered from these climate events. Yes, to continue on the topic of storms, is this going to lead to a modification in your reinsurance programs? And second question as regards the U.S., could you be a little more precise as regards your cornerstone product and the losses in market share? How are you going to recoup ground? Because I have understood that some of your American competitors do not have the same accounting constraints as you do and did not reprice the way you did. And third question, in PNC, there's a small chart with the evolution in tariffs. Can you give us, although this may not be very significant, an average idea of an average price? Some competitors have communicated on an average price, although this doesn't mean much. Could you give us a small indication on this? Thank you very much. 3 questions. I will ask Dennis or Francois to answer on the average increases and reinsurance programs. Now, as regards market share in the U.S., cornerstone and repricing, we are extremely vigilant on the profitability of our business and the accounting standards, which perhaps highlight more quickly than in the US what can be in highly volatile markets, the impact this may have on the new business we underwrite. So there are competitors who I would say are not as quick to respond to situations. Our product, therefore, becomes, things being equal, less competitive. In the short term, we lose market share. This is not something that we're panicking about. We'd like to sell, but we want to sell if the profitability that comes with the sale is profitable for our shareholder and profitable to us. Not everyone has done this. Those who didn't are bringing in products at prices that are not satisfactory. At some point, they will have to correct matters. Cornerstone, to be simple, its main difference versus current products is that instead of giving you a fixed guaranteed rate, it offers a variable guaranteed rate, which will increase if interest rates increase. Why should we do this? And which will, of course, drop if interest rates drop. Why do this? Well, there are 2 advantages here versus the current situation. It seems to me that the risk that our clients will be exposed to in the future are more risks which involve a hike in long-term interest rates than anything else. Long-term interest rates because we're going to have to fund deficits and also fund the economy. And also because we've had some complacent economic policies, and then a guaranteed rate frozen for eternity at 5% is not attractive if interest rates increase. So we need perhaps interest rates that are lower initially, but that are variable and can rise. And this is more favorable to the client, but it's also favorable to the designer of the product because these guarantees are cheaper to produce than products with a fixed rate. So it is for us a way to offer clients which correspond more to their concerns and expectations for the future. We'll see how this will unravel. The product will certainly take some time to find its place on the market, but to the perspectives seem interesting. Who would like to answer the other parts of the question? The first thing I need to say on average increase is that in 2009 already, we slightly increased our prices by 0.5% throughout the portfolio, which means that we did not wait to discover the less good results in PMC in 2009 to start reacting. And when we increase prices during the second half of the year, this does not significantly impact the yearly results. Since these premiums are only acquired over a 12-month period. In 2010, we are expecting an average increase between 2 to 3%. Now, as regards reinsurance policies, We did not change for 2010 the structure of our reinsurance program, therefore it remains the same. This doesn't mean that François Pierson will not look into this in 2010 for the future, but let's say that 2010 has a program that was decided upon between September and December 2009 and has the same structure as all other 2009 programs. Now, I would like to add a few words regarding the U.S. 2 points. There are differences between AXA and our American competition, which is number one, that in 2008 we've taken into account all the losses corresponding to the exceptional economic situation of 2008, whereas U.S. GAAP standards allow people to scale this loss out over time. So the impact on the results of our American life insurer competition, their results are not very good in 2009. They have a very significant stock in unrealized capital gains, and they have put some of their losses here of variable annuities carried it over to 2009. Now, as far as risk management is concerned, measures are fairly rigorous and are based on an environment which is the same as embedded value, a market-consistent reference framework where we evaluate all options and guarantees that we give our clients. And now, as regards retirement cornerstone product, the characteristics, of course, as indicated by Henry, but there's another one as well, which is that the client can decide to have part of the portfolio in the form of unguaranteed mutual funds and another share of the portfolio under guarantee. And the client can at any time move from non-guaranteed to guaranteed, of course, with fees that will be different. Much more flexible, much more much easier to change, to modulate, and for the moment they're sold by proprietary agents. They will go into third-party networks towards the spring of 2010, so we'll need to wait for the second or third quarter. Now, for the moment, we have not planned to roll out this product in other countries of the world because it is the response to the tax characteristics of the American market. So at this stage, we have not yet thought to roll it out elsewhere. Any other questions? Lionel Garnier, Le Revenu. You mentioned your confidence as regards state bonds or govies and your low exposure on pigs. Can you give us your opinion on the crisis, on the public debt, and so on? And have you, in fact, hedged against this? Does this change asset allocation in your portfolios? Well, if you look at our portfolios, I think there's a slide that shows that we have approximately 400 billion in assets on general funds. Out of these 400 billion assets, there are a little over 300, which I think it's 83% precisely, which are bonds. Half are corporate bonds, half are govies, and as we told you, the exposure on Southern European countries, such as, the pigs, as we call them, in all, 20 billion in gross and 10 billion in net. So you can see that exposure is extremely low. There is no specific coverage on these risks. Sometimes on the markets, we see that there are fears. Since there sometimes is irrational enthusiasm, well, there sometimes is irrational fear. This does not mean that we should drop our guard on Greece. What we are looking at is to make sure that community and Eurozone mechanisms will involve authentic, genuine measures of discipline on countries that have not complied with the rules. I think that there's a lot of positive that can come out of this. I have no doubt that the euro will resist. If I may ask you to make a very simple observation, everyone knows that Orange County in the U.S. has gone bankrupt, putting California as a state in very difficult situations. But nobody believes that the dollar will implode. Now the Eurozone is not essentially different. We have a country representing a little under 3% of the GDP, needing to drop its accounting approaches and to learn to manage to apply more rigorous management. And I think that this can lead to better state management. If this is the case, it's good news for Europe. It's not going to happen right away, but I think that what we are seeing arriving on the scene is going in that direction. And adversely, a sort of complacent, blind solidarity without counterpart demands would be extremely dangerous, because it would mean that we can manage any which way we'd like without ever having to assume the consequences of poor management, and always depending on other better students in the class to assume. So I do not think that we will be here selfish or blindly complacent. I think we will be in a very balanced situation to put forward conditional solidarity. And I think if this is the case, it's great news for Europe and the euro. Good morning. Anne de Guigné in the Figaro. You mentioned the recession to partly explain the deterioration in your P&C results. Could you give us more detail? François, the recession loss ratio on automobiles or on SMEs, SMIs. When you look at the deterioration of the combined ratio, in fact, you have the group and you have the countries that were more particularly impacted by the storm. So Dennis showed this in the slide. We have, I think, 1.7% of deterioration in the combined ratio due to climate events and the storm. If we look at deterioration in France, it is much more significant as far as the loss ratio is concerned. We are at 99. Last year we were at 93, and so here we have approximately 70%, no, between 60 and 70%. Okay, let me be a little less approximate. 65%, which are due to abnormally numerous climatic events. It's true that winter is always winter, but we're talking about a higher average than usual. To now, we're going to talk about 40 other percent of the deterioration in the loss ratio, which is, of course, due to recession. Now, we can add up things. Is this due to recession? Is this the result of other factors which are quite identified on automobile policies, for example? The French visibly and consume as other populations in Europe. We have driven more than in the past because the oil price has dropped. Now, the oil price has dropped, and we can see on expressways in particular very strong increase of toll booth visitors. So the increase in traffic. Second observation, still as far as automobiles are concerned, and then I'll make a comment on another branch. We have a worsening in material claims, in their number and in their degree of severity. There are less fatal road accidents, but there is an increased material damage, situation. So not only do we have here an increase in traffic, an increase in visitors, an increase in the intensity of damages, i.e., therefore, of the average cost of claims. So the increase in traffic, is this a result of the crisis? Well, this would be close to the opinion we have. During the holiday months, based on statistic observations, people in Europe have traveled less than before. When you look at the results of airline companies, people have stayed more in their immediate vicinity. Of course, we can say that this is due to the crisis. Secondly, the behavior of policyholders was to call upon insurers as much as possible. In other words, a behavior. Now, I'm not saying that this is a deviant approach. I'm just saying that the policyholders never forgot to call upon their insurer as soon as they could. This is a behavior that was different from the past. They didn't call upon the insurer for small claims, for example. Here, whatever the claim, people asked for money. So to retain clients, because on the first claims, we have no deductible. So here again, policyholder, and we have no deductible for first claim because usually, because this is the way we usually do things. So for each first claim, the insurers paid their policyholders because the first was without a deductible. The second one is also without deductible, although this depends on, of course, the client's capacity to drive normally. And the third one then is a different situation altogether. So this can also come from the crisis. Now, when we look at the risk of the, as far as the company is concerned, we have an increase in loss ratios such as fires, theft, on corporate risk, but also on home insurance, for example. There is a significant increase in the loss ratios there as well, and in the number of claims. So this is an explanation which applies essentially to the French market, but we make the same observation on other markets, European markets, as regards the deterioration of the technical results. Now, for AXA, 2009 is not good news, but I think that we must limit the comments we make because we have returned to the levels that we were at in 2004, and at the time everybody was applauding AXA's combined ratio. So this is far from being tragic. Second thing we can do is remember that our portfolio does not structurally generate negative results. We have to rework everything to make sure this will continue. Yes? Christian Schubert, Frankfurter Allgemeine. I would like to know whether you can make a comment on Allianz. Nope. A prestigious and respectable competitor who's going through the crisis well, but it's up to them to present their results. Who went through the crisis better? Well, it's up to you to judge that. Let's say that their insurance business, we'll see what their results are, but I think they have gone through the crisis fairly well, just like we did. Their model was not initially the same at the beginning of the crisis, which is now closer to ours because they did away with their banking activities. And I'm sure that each of you has an opinion on this, but what we have seen is that we have practically the same stock price at more or less 1 billion, whereas a few years ago there were considerable differences. Next question. Yeah, just to ask you to give me a little more information on the preceding question. For example, I wanted to know how you intend to improve your combined ratio as a result of the measures you will implement, and can you specify the impact of claims in France and the underlying earnings for France? Well, you probably have the underlying earnings numbers in the appendixes to your documentation. As regards the combined ratio, what we have displayed here is that our policy was to be between 95 and 100 based on cyclical evolutions. We are here at 99 because we are down in the cycle. What we will do, what we hope to do, what we think we'll show you next year is something that will be turned around. It won't go back down to 95 immediately, but we will certainly quite probably have improvement by next year. In 2010, we intend to improve the adjusted ratio, because you must have seen in our document that we have all FYs combined at 99%, but the adjusted earning and the boni on preceding fiscal years. So a favorable position regarding the provisions we have to cover claims from preceding years. They were important in 2009. They were important in 2008 as well. We believe they will be important in 2010, and therefore we are going to work at improving our adjusted loss ratio with repricing and management of claims. We have a policy where we provision quite conservatively in the first year, but then we increase bonuses in the following years. We've had a very favorable situation in this area. And as Dennis is saying, what is important is the ratio that we certainly hope to see lower. Can you shed more light on the operational losses of your banking area? Freddie, you want to give an answer to this one? Our bank is first and foremost a small bank, which is today highly focused on Belgium. So please remember that our banking strategy was to create banking subsidiaries in Northern Europe, essentially, which was there to extend the model that we had for Belgium. Now, creating a subsidiary is costly because you need to equip them with information systems, set up all the infrastructures required, although our model is relatively lightweight. Last year, we created a subsidiary in Switzerland, one in Czech Republic, one in Slovakia. And the development expenses, which represent between 10 and 15 million euros per subsidiary created in new countries, have, of course, negatively impacted the underlying earnings of the banking business. Now, there is here also an impact of the banking crisis. Our banks are essentially retail banks, which initially target the inflows of short-term savings. Now, once those net savings have been put into the bank, we suggest longer-term products. This is the famous pump that I described in the preceding years. Well, what happened last year? Well, many banking institutions no longer have access to the interbanking market. They overpaid short-term deposits. If you take the French market, for example, if you take foreign markets, it was quite frequent to find offers for savings and different accounts at 2.5, 3, 4, 4.5, sometimes 5% interest. When you have rates at 0.5%, well, obviously, this is a very difficult competitive situation. It is becoming more normal now, but we have gone through a period where retail banking, at least as regards deposits, had a difficult competitive situation, and this, of course, weighed heavily on our results, although this is mitigated by the fact that we have specific asset and liabilities management policies. There was a question at the back of the room earlier on, so that the microphone does not remain in the front only. Yes, hi, Séverine Solier, La Tribune. I had a question on Solvency II. You indicated earlier on that insurers did not require additional capital, but it does not seem that regulators are of your opinion. Are you optimistic as to the demands that will be tested within the framework of the QES5 that will arrive soon? I think we have to be more nuanced in these areas. I would like to remind you of the fact that the Commission was very clear when it said that, in its opinion, Solvency II should not lead, that there was no initial requirement for additional capital insurance. Then regulators, and we're not yet at QES 5. Yeah, it's not regulators, they're supervisors. Supervisors can, of course, carry out extreme sensitivity tests, but nonetheless, whatever the result, we will need to retain to the text voted in by the European Parliament. Supervisors are not going to invent Solvency 3 or 4. There's an extremely specific framework that was set by the European Parliament, which is that solvency must be measured with a landscape of 1 year and default probability of 0.5%, i.e. a bicentennial event. So we need to have sufficient capital to resist a bicentennial event, not a bimillennium event. So all of this has will gradually settle down. I think it's a question of calibration, to be honest. And as far as calibration is concerned, we will have to make adjustments. And the discussions are quite active between KOPS, the European Commission, the industry, but very clearly, both by the European Parliament and Commission, it was said that the framework in which we will be working is the framework of the vote of the directive and no other framework. So this may take a little time, but we're not very worried as to the outcome of discussions. Yes. Completely different topic. Greece has optimized or manipulated its gearing situation with the help of Goldman Sachs. At the time, Goldman Sachs was the leading forerunner to sell Greece to such institutions as yours. Have you already undertaken your in-house investigation? Have you made a mistake? And are you thinking of a recourse against Goldman Sachs? This topic is not of any interest to us. Full stop. Any other questions? Are there questions on the phone, ladies and gentlemen? There would not seem to be any questions by telephone. If there is no last question in the room, I suggest that we suspend the session. Thank you for your attention.